Hey, everyone here at the Investing Stuff podcast. We have an exciting guest with us today, Nicole Borderlon. And Nicole has a long background in banking and other probably pretty fascinating things. She's a former commercial banker, treasury management sales consultant of 17 years. She's a certified treasury professional, CTP, certified purchasing card professional. A lot of C's here, certified CFO advisory and a certified exit planning advisor. Like those things are like beyond my knowledge and my expertise. But to break it down in more common language here, she's basically a consultant for startups to large middle market and publicly traded domestic and multinational companies across all industries. She's been in energy, oil and gas, midstream, up downstream, including retail, health, government, construction, industrial services, investment funds, and private equity. Holy smokes, Nicole, thank you for being with us.
Thank you.
Awesome. So we're going to talk about, so we were part of a group. We met down in Cancun, Mexico at this fund mastermind. A lot of people there. It was a very exciting event. You were one of the speakers at the event and you spoke about treasuries. We'll get to that in a minute here, but we're going to talk about two things for people joining us. Just like I know people know that I like to get to the meat of stuff right away. But first, give us a little bit about who Nicole is, and then kind of where you grew up, and then how did you get into banking, so deep into the banking? You spent, a fascinating career in that space.
Yeah, it's been an interesting journey for sure. So, so my name is Nicole Borderlon, and I'm from Louisiana. I reside currently in the Baton Rouge area, and yes, I am originally from Louisiana as well. So, um, I kind of getting started. I went to college LSU for economics, international economics, and Spanish and criminal justice. So I already knew my goal actually was to never work in banking. I did not want to work in banking. And but I liked actually white collar crime. So I was actually in the hiring process with the FBI.
Oh, wow.
Yes. And so when I graduated, but it was taking a while and I needed a job. So I started looking at jobs, and funny enough, I found this job in Treasury with a bank that doesn't exist anymore called Wachovia Bank. And Treasury sounded really fascinating because I did bookkeeping in college, and it was kind of the flip side of that. You work with accountants, controllers, CFOs, stuff like that. And Treasury is really just around, cash management best practices. And so I started my career in banking and treasury, and I loved it so much. I stayed in treasury my whole career. So almost 17 years. So I ended up with Wells Fargo bought out Wachovia in the last financial crash.
Yes.
And so I was with Wells for about 12 or 13 years. Then I moved over to Chase Bank for about another 4 years, and then I left. So over the years, I've moved around between Miami, Dallas, Kansas City, and Phoenix and Denver. And I covered a lot of different sectors along the way, worked with a lot of people. So I spent a lot of my career just in general commercial banking.
Yeah.
And depending on the city you live in, there tends to be a concentration of stuff. So maybe in Dallas, I had a lot of, big box retail stuff. I had aviation, but I spent almost 9 years in oil and gas, specifically in the oil and gas team for Wells. And I actually loved it. It's probably one of my most favorite sectors ever.
Really?
Yes. I
Why?
love oil and
Why?
gas, because
I mean, I love energy myself. Like I'm not against energy. Like I'm literally super
oh
pro
good, yes,
energy.
I
But so
am
I love the space. But
anti-ESG, so
yeah.
we'll be right up front. I am anti-ESG. That's a whole other podcast episode by itself. But no, I love oil and gas. Oil and gas is a vertical. Banks have verticals to handle very specific industries like healthcare, government, etc.
Okay,
And
that's actually something I kind of knew, but like not really. But okay, now you're kind of confirming that's their, there's a very, it's a, you could actually define it as this is when this is very a space that
yeah,
these people play in, right? This is where these
exactly.
teams work. Gotcha.
Yes. And so, but they really, there's verticals over a certain revenue threshold. So typically, like middle market companies are considered maybe depending on the bank, but say business banking might be 5 million to 20 or 50 million in revenues, and middle market is like 50 million to 5 billion or something like that. Or yeah, every
Mm,
bank defines it differently.
okay.
And so anything say over 500 million kind of teeter totters in the investment banking space at a bank. So it's like these tiers.
Yeah.
But in some of the verticals like healthcare, government, stuff like that, energy, that falls in the large corporate world at Wells. I'm giving you way more details about banking than you care to know. But so I say all of this because working in energy was a little different. We didn't just do companies over that dollar threshold. I actually did startups to very large, multi-billion dollar publicly traded energy companies. So getting to why I liked energy so much,
Yeah.
most of my portfolio is E&P companies, so companies that drilled for oil or gas. But I did midstream, I did energy services, I did mid-cap refineries, and I had C-stores. So I had like the full, from the ground down to the pump, I had the full line of
Wow.
companies. So it was
Yeah.
very interesting to really understand the whole like supply chain. But then because I had startups to really big companies, every day was so dynamic and different. And there was so much M&A activity back when I worked in oil and gas that
Yeah.
literally.
Approximately what time horizon was that? What that
So
time frame?
I started in oil and gas around 2013. Well, it was after the crash. I literally moved to Kansas City and they put me on the oil and gas team.
Mm,
So that would have been like 2012, up through about 2018. I might have started before that because I actually supported oil and gas throughout the merger as well. I
sure.
was handling the big company. So like
Yeah.
these are 2009 to 2018.
Sure. No, I just, yeah, just kind of just a range
Yeah.
there, just give it,
So
give a sense there.
yeah, I went through a couple peaks and a couple like valleys.
Yeah. Right.
And so but there was a lot of M&A activity always happening, and so it was exciting because literally tomorrow I might have this little tiny company and they either got acquired by someone or they bought someone and all of a sudden they're a huge company and everything about their treasury now changed.
Oh,
So,
I love that. I love that. So that's an excellent segue into what you spoke about at the conference there,
yeah.
Nicole. So let's talk about give it to a simple again. I know you give a simple definition, but let's just make a point of it, like put it kind of bold it. What is treasury, and who are the people that should be, who are the teams and the verticals that should be thinking about that, and then what are some best practices around treasury? I know that's a bunch of questions, but so like what is treasury? Let's start there.
Okay. So treasury really in a nutshell is just cash management. So
Cash management.
yeah, so as a consultant, I was just consulting on best practices in cash management. I mean, treasury is payments, it's the movement of money. So whether clients, or companies, they have receivables, payables, working capital, short term investing, long term investing, or fraud protection,
Oh yeah.
anything about money to protect it, to make it, receive it faster, to make your payables slower, you know, everything about your money and protecting your money and moving your money is treasury management.
Okay.
So
And how does that? And so my simple mind, I'm like, well, as long as I don't run out of my cash, I'm fine. Now you were telling us at the conference, like, no, the rules change. And if a little fish eats a big fish, like you could actually get hosed and lose everything, and they can't insurance and like this stuff that I wouldn't even conceive of. So what are some things that to look out for, and how does that, what are some big errors you've seen out there?
well, I don't think so. Treasury, in my, to my experience, doesn't become a problem in a business till they hit about 30 million in revenue.
Okay. Okay.
Treasury is really not a concern. It's not a problem. They don't even have a treasury person in the company. They're fine with their QuickBooks, and as long as clients are paying them and they're paying the bills, like they really don't care.
Yeah.
When companies start scaling, getting bigger in revenues, and they start to bring on, say, a CFO, they're starting to look at, their outstanding receivables, their payables, like, oh, maybe we can pay these guys slower. We need to get paid faster because we're behind, we need the
Uh,
cash. So then that's when you start tweaking the payment types you offer people and the payment types that you want to pay. Maybe you'll accept credit cards, maybe you won't, maybe you want to pay with a check, maybe you don't. That's when you start fine tuning your operations. Maybe you start using a more sophisticated accounting system that does different things, maybe some cash forecasting. That's just, you just kind of go to the next level. So, what I was kind of saying at the conference, because this was all fund managers, is that most people in general have the perception that banks, care most about deposits, or care only about deposits, and that's where they make all their money. And
Yeah.
deposits are very important, but that's actually not how bigger banks that have treasury make a lot of money. They care more about treasury. Treasury has higher profit margins. It's very sticky. It's very hard to pick up and move when all your bank accounts and all your services and your online banking and your integrations are all
Oh,
connected.
yes,
It's,
yes,
it's a pain. As a consumer, it's a pain. When
yes.
you just have auto drafts, imagine a company, your accounting system is coded, you know, to things happening with the bank. So bigger banks love treasury because it makes them more money and it's sticky, so it retains you as a client.
Yeah.
And so many companies don't realize the value. They have a lot of value in their back pocket and they just don't even know how to leverage it, or they don't even know that it's a leverageable tool.
Well,
So
let's drill into that a little bit there. So banks like it. Customers aren't really aware of like how it's almost like an asset and that you can leverage it and take advantage of it. How would a company monetize it or do that better? I know we're talking about large organization, like you said, 30 plus million. What are some things there that a company would consider?
yeah, so on the fund side, I think it probably impacts private equity the most.
Sure.
Um,
That's
Private
a good
equity,
distinction. That's something else. So like, there's like oftentimes a lot of people here on this podcast, the guests are listening to, or maybe real estate or syndicators or people in the fund, but there are people that are listen to private that are in private equity that that also are listeners as well.
oh, okay. Yeah, so I would say it impacts probably private equity the most, because private equity is buying, businesses, or buying part ownership in a business. And so when you buy the business, you're buying the whole bank relationship and all the services. And I did have some sponsor companies when I worked in banking, and hands down, the biggest challenge that we on the banking side had is that the private equity guys don't know anything about treasury, and they don't care about it either. And the private equity folks buying these companies, once they close the deal, like, they're done. They kind of walk away from the banking side of things, and they leave the onus on the existing CFO that's in place, that, oh, like, they'll just figure it out, make it work.
Yeah.
And a lot of times when companies do get bought out, they're actually, usually excited, and they think that we're finally going to have the budget to upgrade our accounting or get all these things they always wish for. But
Right.
when the sponsors don't even understand the pain points of treasury and finance happening down there, they don't value the technology investment. Like, I just posted about this on LinkedIn a couple of days ago. I don't know if you saw my post.
No, I didn't. I actually I was looking at your link right before we jumped on there. I was like, oh, there's some good stuff from Nicole here. I wish I would have seen that, but no, I didn't see it at all. I'll go back and read it.
So this is a good, I'll just talk about this super quick. So the Southwest Airlines recent infrastructure meltdown,
Oh yeah.
classic example.
Yes. Yes.
This is an example of someone in leadership not valuing reinvesting in a company and in treasury and operations, and it literally melting down.
Wow.
So I've seen where private equity will buy out a company, and they don't either really know, or they don't understand, or they don't see the value, the ROI in upgrading an accounting system, because it doesn't impact the bottom line. Because let's face it, private equity, we're looking at returns. And so that is the biggest catch 22 that we see when private equity buys out someone, is they don't actually invest, which could translate into other efficiencies down the road, but actually will translate into a higher multiple when they exit and sell. But they don't even know that. They don't
Mm,
understand that. And so we see this gap in communication where the sponsors will put the onus on the CFO left in the company. The CFO's hands are tied because they can't make a decision to do whatever it was they wanted to do with treasury.
I
And
see.
so then nothing ever happens.
So there's
And
that potential value is never unlocked then because of just kind of this messy way
it's just,
the acquisition and then the ignorance, of the acquiring the team that's acquiring, and then yeah, so it kind of breaks down. So that's really fascinating. There's another source of value inside the company. You could just crack it if you knew with the right team, with the right team, the right investment, the right focus, you could unlock that.
yeah, I mean, like it really translates to a higher valuation on the exit
Yeah,
because, I mean, you think about if you bought a business or anything, you want someone to have cleaned it up and made it nice and pretty. But now, if I have to do all the dirty work and go spend, $1 million on an accounting system upgrade, then like your valuation just went down. You really didn't do
absolutely.
like pumping money into Facebook ads to generate more traffic. That only goes so far in evaluation. So the other thing was with private equity specifically, and I know we're knocking a lot on private equity, is that was my job as a consultant, was to be able to get in front of them and then educate them so they could be like, oh,
Yeah.
this does sound interesting. Let me bring the CFO in. But because they didn't even really understand what treasury was, they wouldn't even take meetings. They wouldn't even
Mm.
take a call.
Oh wow. Wow.
So so to kind of, pivot over is sometimes, especially when you're private equity and say you have all these different businesses, banks both love and hate private equity, actually, believe it or not. And I know, especially newer fund managers, I'm not going to say have a sense of pride, but, it's like, well, we're private equity, we're buying this company. And it's like, there's this gap where banks don't like you and then they love you.
Yeah. Is it like a maturity level? I mean, do they look at you like the emerging fund managers like a teenager and then like a middle-aged executive? Is that how they like? I was like, oh, we like dealing with the middle-aged executive, or what's a good analogy there?
It's more in terms of the lever. I think it was a startup as a new fund manager
Yes.
or a new fund, you are a quote unquote startup.
Yeah.
And later on, you're highly leveraged. It's just like, ooh, it's a different risk appetite. It's just a different risk appetite.
For
And now
sure.
we're into a very conservative credit environment. The risk appetite is very low.
Yeah.
But if you are a big fund with, 100 million or something like more, they see the balances, they see the treasury services, and like, so then the risk reward kind of pays off because
I see.
like I was the one on the other side of the table having to justify to management, this is our profit margins, this is how much money we can make. So credit can be like, okay, maybe we'll sign off on this loan or
Yeah.
sign off on, because there's products that most, people don't really think about. Credit cards, even depositing a check on your phone,
Yes.
there's credit exposure behind the scenes. All of
Wow.
that a bank has to look at.
Yeah.
So, when you have like you're buying all these companies, one, it is good. It is good. But on the flip side, the more companies and the more products, the more risk, the more credit exposure. So
That's fascinating. Like, so let's just say you were to buy, just making up a company here, and they had, for whatever reason, had hundred thousands of customers depositing paper checks via their phone, and then like you would look as a technical expert in the space, you would look at that as one of the many things to factor in to, this business, if you're going to acquire it or just run it, that's like you said, it's a background or a hidden credit risk that you have to factor in among many others.
yeah, yeah. And so it's both good and bad because when you're a smaller fund, it's very tough. It's just like being a startup business.
Yeah.
Not every bank wants a startup. So it's like, how are you supposed to get your break? How are you supposed to get leverage? So a lot of times they rely on private lending and things like that. But when you start buying companies, you start having that volume
Yes.
with bank accounts, credit card spend, all these things that start adding up. So over time, your leverage with a bank becomes higher. So then you can say, I really want this loan. I need to go buy this other business. I have all this treasury. So at some point, as you get to a big enough fund and you have enough leverage, you start kind of splitting it up wallet share. That's what we
Interesting.
call it.
Yeah.
So maybe your credit card is with one bank, your receivables with another bank. I mean, there's 10 ways infinite ways to probably exclude this, but
Yeah, yeah.
maybe each business is with a different bank, or each product is with a different
Interesting.
bank.
So then it's like, and then just another analogy, in my simplistic way is like, let's just say I had a printing company and I wouldn't want, let's just say I didn't want to give all one company all my business, like 90% of my accounts.
Exactly.
So if they decided they didn't like me or we got mad at each other, like we'll wipe out my business. So I strategically spread my business, or even split some of my business. Maybe I get half of it to, Mr. Bob's and Miss Sally's down the road or whatever. And like they each get a chunk of it. So
Yeah.
I'm not getting too exposed to disruption or whatnot.
Yeah. So that's lots of benefits even for you. So yeah, like think about on the real estate side. Like let's say you send out 100,000 mailers a month.
Yeah.
Like at this, it's when you start off, you build up your volume so you get a discount with Mr. Bob. But then at some point you have enough to give to Mr. Bob and Miss Jane. And so now they're both happy. Maybe you got price discount both places, but now there's extra benefits like business continuity planning. What if
Yes.
Mr. Bob goes out of business? What if Mr. Bob's building burns down? Like,
Yeah.
what are you supposed to do? Because it happens in banks, like
Mm.
especially in the last few years,
Yes.
entire banking systems have gone down in a day for 3 days.
Wow.
So it's always good to have redundancy and have multiple relationships. And even small local banks, they have like very simple treasury stuff. But almost any banking site you go to, there's a header. It says treasury management, and they might have a few simple services. They buy those and white label them from big banks, but they all care about treasury because they make money. They charge you $15 for a wire. That's treasury.
Okay, yeah. Well, that's fascinating. Let's pivot to another fascinating topic that you alerted me to, and we'll step into it by explaining to the folks, and you can share it or not. I know I'm setting up a fund. I'm basically almost signing. I'm literally going to sign the final docs this week. You're setting up a fund. Could you explain to us what your fund is, that's just more of interest, and also tie it into the central bank digital currency, the CBDC. So explain your fund. Then you actually added some wording and you just shared that with me. And then we'll just kind of do a couple paragraphs on each of those. And we'll kind of deep dive into the central bank digital currency, which is a new thing. And you alerted me to some risks there, some potential risks.
Yeah, it's a lot of risk.
Yeah.
So I have a partner. We're launching a fund together as well. I wish that we were signing our final docs during edits, but it is a commodities and hard asset based fund. So we are not trading, public equities. There's no contracts, no nothing like that. My partner Ken, he's been doing this for about 20 plus years. His dad's been doing this since the 60s. They actually either buy and sell physical assets like, airplanes or aircraft engines,
Oh, wow.
or
Okay.
all oil rigs that need to be decommissioned, cut and scrapped, or maritime marine salvage.
So like,
Say,
I guess to say it in like these some big items, so like large. We're not talking
oh
like,
yeah,
I don't know, we're not talking like lawnmowers. We're talking like these
no,
big,
no,
like,
no.
very, very high price, single structure that have, that are very complex, but
Yeah,
are very expensive. Yeah.
yeah, which is actually kind of what turned me on to this, because I met Ken about 2 years ago at an M&A conference.
Mm.
And at the time, I was thinking about offering fractional CFO services. I was still in banking, and he's, talking my ear off about what he does. He trades
Yeah.
cell phone recycling and all these things. I'm like, oh, that sounds whatever, fine. And then he's like, oh yeah, my dad, we do ship breaking, and my brother works in that field.
Really? Wow.
The drafter.
Here,
He does
here in the US, or like over in like Laos or Nigeria or something where they do that commercially.
no. So my brother is in Virginia,
Okay.
but he's more on the construction side, not the ship breaking side.
Sure.
But
Okay.
he's more on the design and the repair of like military ships.
Okay. So like Newport News, that base.
Yeah,
Yeah.
in that
Okay.
area.
Yeah.
So he's handling big, complicated, fancy stuff,
Yeah.
right?
Large pieces of steel that are very, very engineered.
Very top secret stuff, right? So I know enough about this.
Yes.
And then I worked in oil and gas for a long time. So then I meet Ken, and he's like, oh yeah, we trade this, we trade that, cell phones, blah, blah, blah. I'm like, okay, whatever. And he's like, yeah, we do oil rigs, we'll haul them in, we'll scrap them. And I'm like, And he's like, we'll do like, decommissioned naval ships. We'll cut them up, scrap them. And I look at him and I'm like, who are you? Like, what? What did you say? He's like, oh yeah, my dad used to have a shipyard and we break them down. And I'm like, whoa, like, okay, pause. Like, tell me more.
There's
You know,
probably more people that own 100 plus foot yachts than own shipyards.
yeah, I mean, and then I found out there's only like a few shipyards like in the whole country, right, that do this. And so, long story short, he had been syndicating deals like this for years. So I told him, Ken, you need a fund. He's like,
Yeah.
what's a fund? So here we are 2 years later launching a fund because he'll
Yeah.
get very big deals like that. But I mean, we'll also trade commodities like, chicken, soybean, but also like coal. We have two
But
deals.
these are large purchases, Nicole. These are like massive.
Oh yeah.
Yeah, like
Yeah,
these are
so
massive purchases, I would imagine.
we are launching a fund to raise capital because he's done this for 20 years. But
Yeah.
every time he syndicates, there's only so big of a deal size we could do.
Yeah.
I mean, like I said, he's done 747s and aircraft engines and oil rigs before and ships, but now we want to scale that to more of that. I'm like, right now we have 2 deals in the pipeline for like 20,000 tons of coal. Like that's, now we're thinking about selling that to like nuclear power plants if we got the contract. So that's the kind of stuff we're dealing in, is like real hard asset-based physical trading of goods.
Gotcha. And then so that's actually fascinating. That's just blow my mind. So then you said you're working through your docs right now, and then you actually added some language about the central bank digital currency, the thing we kind of started off the section with, this section of the show, CBDC. So
Yes.
First explain to us like basic language. You said something about the president issued an order recently. Give it to us at a high level, and then tell us what you did, and then kind of elaborate from there.
Yeah, so the central bank digital currency, in March 2022, there was an executive order that came out. Basically, it was supposed to be the blueprint for researching digital currencies to just see if they made sense. But really what it was laying the foundation of central bank controlled digital currency to come.
Okay. Yeah.
Because at that time, there was about 105 countries around the world that were also exploring it, researching it. And now, I mean, that was March 2022.
Yeah.
Before the end of 2022, like 85 countries had already committed to moving forward. So it's
like all together, like they're all got like the same underlying parameters and code and whatnot for that, like decentralized. Yeah.
I mean, that's the theory, right? So,
Sure.
Follow the World Economic Forum. There's a mission for one world currency. So
yes,
we'll see if each country will have their own, because now there's BRICS. So BRICS is a group of sorry, I had a call come in. Yeah, edit. Okay, so yeah, before the end of 2022, 85 countries had committed. And so now there's BRICS. And BRICS is a group of countries and is growing, by the day. And that stands for Brazil, Russia, India, China, like Saudi Arabia, like South Africa. Like it's just growing now. There's
okay.
way
You're
too
gonna
many countries.
have to change the word, well, we still know what it means. Kind of like this alternate these large countries that are around the world that are kind of like, they're kind of tired of the US being in charge, and they were trying to have kind of a countervailing force on the global stage, right?
Yeah. So they've committed to their own currency. Yeah, now it's like BRICS, there's multiple S's, BRICS is but there's more countries now joining, but they have committed to having a gold-backed currency. So, I mean, then now there's all this stuff with Russia and China. They have their own agreements, to buy oil in the yuan or in the rubles. There's so much stuff now transpiring in terms of currency, and our own monetary system is horrific, to say the least.
Yeah.
That the bond market is insane. Like it's just on this path to escalation to where it's basically going to implode.
Yeah.
I mean, it's not sustainable. So the speculation is that the implosion is almost intentional in a sense,
Yeah,
though there's a lot of believers that Jerome Powell's trying his best, whatever. But, there's the theory that the escalating debt is intentional in order to implode, because then we can justify a reset to move to the digital currency.
I see. Okay, so that's
So
kind of the theory, like you said. It's kind of the theory about one theory that where this might be going, and we know for a fact. So that's like the background, like potentially why. I mean, so we see, and anyone that really wants to see a really deep background on the fiat currencies and central banks, read Dalio's Ray Dalio's work,
yes,
who does a
exactly.
phenomenal book on that. He lays it out for going to thousands of years. So that's a deep background. But then also, so that's happening. We see like actual bad policy, at least from if you actually wanted to preserve it. But then concurrently, we see this giant push and happens to kind of just converge with the digital, blockchain emergence, really kind of, that's kind of an emerging thing. So the theory that within that is like, are they trying to like blow it up and even maybe even go faster? So that's the theory, but both things but as far as what's actually true is that we know we're doing, terrible things as far as keeping the currency, its value up. And also it's also true that blockchain and crypto and all that kind of stuff for these, like you said, these get the central bank digital currencies is also actually a fact. And those things are real. So those two
Yeah, it's
things are
very
real.
real.
Yep.
So what I've been preaching to the darkness for months about this uh central bank digital currency. How even my brother joked at Christmas, like, oh, I know you're a fan. I'm like, don't get me started, right? So I mean, it's very real, and the press doesn't talk about it very much, and or people put their head in the sand thinking, oh, it's fine, it'll work out, maybe it's a good thing. And I'm like, no. So
And
but
what
it's
risk did
very
you?
much.
So let's make it real, just real quick. So we can talk obviously some theory and some high level stuff. Let's make it real, just real quick for the audience. You actually added some language. What risk do you see? There's a lot of syndicators out there and capital raisers and fund managers. What is the risk to us, like right now or soon, or potentially?
Yeah, so this is kind of like, this is it in a 30,000 foot view. I have not had this conversation with anybody but you and my
Sure.
partner Ken,
Yeah.
and I'm interested to see my attorney's feedback because he
Yeah.
probably has no idea. I probably like blew his mind with this stuff.
Yeah.
But the thing about the CBDC, it's already in pilot with 12 financial institutions, so it's real. It is real, and it's happening, and it's coming.
Yep.
I know that Fed Now is rolling out June 2023. There's a white paper on it. You can go read about it. So I think it coincides. With maybe the first launch of CBDC.
Mm-hmm.
So in order to prepare for this, so the reason why I say prepare is because then I have to talk about why I think CBDC is not maybe good.
Okay. Sure.
So
Fair enough. Yeah.
some months ago, the SEC has put out a proposal, and it's all very coincidental and stuff ties together. There's a proposal that would regulate um, any company with investors. So whether
Yeah.
they're publicly traded, you're an investment fund, you would all start to be regulated by ESG stuff, your emissions and blah, 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 right? And so now with central bank digital currency, and this is happening right now in Europe, where you have a personal social credit score stuff, is that now if there's a central bank digital currency, there's two things to that. One, it's now digital. They can now freeze it. They can control X dollars or allocated to entertainment, to groceries, to whatever. They can track it. They can do all these things now with it. Layer in the ESG component of it. You aren't diverse enough, you don't donate enough, you don't do whatever, you donate to the wrong people, like whatever.
Yeah,
You
this
put off.
these other value, these superimposed values on what we thought was like philosophical, religious, political, they're now being inserted.
Used against you. Yeah.
Yes,
Used to control.
potentially used against you, like you now will do this, and
Yeah.
basically a heavy-handed dictatorial whatever fashion. But so you see this being very streamlined, and then the powers that be in the different countries being able to mandate this, more or less it will, if this continues as it's kind of seems like it's rolling
Yeah,
out.
because now, like, I was talking to a guy in Canada. It's been tracking them for some time. So I just noticed this on Google Maps the other day. There's like, if you plug in a route, there's a little green leaf that shows up. You save this much in gas and emissions if you take this route instead of this route.
Yeah.
So that just kind of recently popped up here, but that green leaf has been tracking, all this stuff, where websites he was visiting, all this really crazy stuff. So now all of that kind of starts getting layered in together, right? Now it's starting to be tied together. You invest in the wrong things, blah, 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 blah. So the third leg of this stool that I don't like is that it is now a central bank digital currency. Like, I'm sorry, but I am one of those people in the camp that says in the Fed,
Yeah.
you
Okay.
know, because when central banks now own the currency, like, you're effectively taking the banks out of the equation.
Okay.
So now today, banks exist. When you have a bank account, your bank account is at the bank. It's at Chase Bank or your local community bank, wherever. Bank accounts are now owned by the central bank.
Yeah. I see.
So today, when you make a transaction, the only the clearing happens with the Federal Reserve. They're just like on the backside.
Yeah.
So the bank can see, you went to Walmart or Walgreens or whatever. So going forward, if the central bank owns the account, they also own the visibility of what you are doing, where
Yeah.
you're transacting.
Completely, complete visibility. Yeah. There's not like,
Yeah,
I mean, so there's like, it's kind of fragmented. It's discrete in, yes, there's still, I mean, also to be fair to the discussion, there's still a lot of tracking, visibility, and things that, these large, like you said, the clearinghouses already know, and depending on the size of the transaction, but it's not nearly so streamlined, and nearly kind of the big brother style of control. And then
yeah,
also, when you're looking at the people that are controlling these large institutions, that the elite powers and the elite powers that be, there's a lot of the common people like us have some serious fundamental disagreements of how they view the world, how they view, many things. And so
yeah,
when you see them in charge, like this makes us nervous, right? That makes you
yeah.
nervous.
So now that's the third leg of the stool, right? So now you've got this melting pot, you add everything together. If your social credit score or whatever is not right, they own it, they control it, they can freeze it. If you're in the
Right.
wrong place at the wrong time, you're donating to a church,
Driving a
whatever.
pick driving a pickup that used too much gas, donating to a church, you didn't
Yeah,
have your
you like to
mask, you
take the
didn't have your
long
mask
drive.
on.
Yeah, you like to take the long drives on Sunday afternoon through the country. Yeah, well, guess what, buddy? It's a little too much carbon emission. So I'm not a fan of CBDC. Okay, I am
Gotcha.
fighting it for whatever that's worth. I've been following, and again, not much of this is in the news, in the
Right.
press.
Yeah.
The state of Tennessee, I'm keeping an eye on. I will probably take up residency at some point, or second residency in Tennessee. They are trying to create a state sovereign bank that is
Mm.
backed by gold.
Oh,
So
wow.
they will not have to participate in the Federal Reserve, because when CBDC rolls out, it will significantly impact small banks. You
Okay.
won't need a bank except for ancillary services like mortgages or whatever anymore.
Okay. Yeah. Yeah.
So, in order to protect their banks in their state, the state of Tennessee wants to create their own state sovereign bank, and they want to be the quote unquote Federal Reserve, and back all the banks in their state to continue operating BAU. And
Sure.
apparently, there's a really great interview. It's about 36-minute long with Senator Frank Nicely out of Tennessee. It happened about 2-3 months ago. It's right on with him. He is 100%. And he is on a podcast interview with another former banker. I
Okay.
think her name is Mary Catherine Austin or something like that. She's on stage speaking about what I'm speaking about right now.
Amazing. Okay.
Apparently, North Dakota, I think, I did not know this. They're modeling this system after North Dakota. So apparently,
Oh,
North
wow.
Dakota sovereign bank. I did not
My
know that.
my wife is from North Dakota. I got my mechanical engineering degree there. So wow.
Really?
Okay. Yeah.
So yeah, I found it so fascinating. So I did government consulting the last few years at Chase. And
Oh,
so
okay.
kind of outside of it now, I've been engaged with some state financial officers.
Yeah.
So I am preaching about all this stuff because some of them are not fans of ESG. But anyways, long
Right.
story short, if CBDC rolls out, then there's just inherently a group of people that are not in favor. I want no part of it or as little part to do with it, as possible. So I've said for months that, another that's going to be like a black market, right? People will use Bitcoin, they'll use metals, they'll use anything else to transact in their daily life. And so in the event all of this transpires, I mean, it's a matter of time that it will. I went ahead and put language in our PPM
Yeah.
that in the event there is a systemic monetary change, that as a fund manager, I have the discretion or the right to pivot and change how I pay out distributions to our investors, whether it's CBDC and we still keep down that path, or we want to pay out in Bitcoin or pay out in something else that I'm already like 20 steps ahead of the game
Wow.
and planning for that, because when it comes, I don't know, everyone's going to be throwing their hands up like, what do we do? Like, I guess we'll just pay out in CBDC. But then, so it goes back to that SEC proposal.
Is it defined? Is most PPMs defined, Nicole, that you have to transact in dollars, or does it define
Ah,
the
well, yeah,
currency or?
actually, I found it buried because ours is like 95 pages long. I found it buried about, page 50 or 60 back or something.
What did it say? And not that yours would say with mine, but I'm sure the legal language is there's similar intent and structure there. What did it say?
It
US
basically
dollars or?
outline, distributions. They'll be paid quarterly, monthly, whatever. They'll be paying in US dollars and we move on about our business. It was very nonchalant.
Okay.
So I was like, well, if US dollars doesn't exist anymore, is it USDTC or whatever, USDT, USDC, is it Bitcoin, is it whatever? So I left US dollar in, but then I
Yeah.
put in language that in the event the US dollar goes away and it's now CBDC.
Okay.
Or whatever.
Yeah. I mean, so just to drill into that point just real quick. So if all of a sudden dollars no longer exist and CBDC now existed, wouldn't that like null the PPM anyway? Or what would you
So
do?
basically, the central bank digital currency is set to replace. So if it is the same equivalent,
Mm-hmm.
it's
People just
probably,
like shrug and just like, okay, that's the equivalent of US dollar. This is what we do now.
yeah, this is just a US dollar. What I also worry, what I also worry about is the valuation,
Yeah.
because if our debt resets, what is a dollar today worth in the future? Is it worth a tenth? Like,
Sure.
I don't know.
Yeah.
So all of these things are transpiring and bubbling. And the other thing I kind of mentioned to you is business trust. They're so
Yes.
unknown.
Yeah. Let's finish up with that with that kind of the last little subject segment here. Yeah, and
Okay.
business trust. That's
Yeah.
fantastic.
So I would say in the last year or so, as I was already kind of going down the rabbit hole and a lot of this stuff, I came across a very unique trust. It's a contract law-based trust versus a statutory trust that, your attorney on the corner, creates or writes up, because like statutory trust, like traditional trust that you go get from an attorney's office, are defined by the government. What the government creates and defines, the government can control.
Correct.
So if you have a living trust today and the government passes legislation that says living trust now do XYZ, like that's what you have. And that's why you have an attorney to keep on top of that stuff. A contract law-based trust is what it is. Contract law supersedes statutory law. So like if you and I got into a consulting agreement, we drew up a contract like that, it is what it is. Like our agreement is within the contract. It doesn't change.
Sure. Yeah. And and I know that distinction only because I did overfunded whole life insurance. And also like, they're like, yeah, this has gone a long time. The reason this is different, you can't, they can't tax it once it's, rolling, is because it's contract law. So that's the
Yeah.
perspective that I know it in. Yeah.
So contract law is critically important. So anyways, with contract law, I really learned more about a beneficial trust and a specific business trust. So I only set this up for any of my clients. Otherwise, I don't really fool with it. And I don't personally set it up. I work with an estate planning firm and a law firm out of Texas that does it. But it's very important because what 99% of businesses also don't know is checking accounts are subject to bail-in. And so in 2008, when the crisis
What's,
happened,
sorry, what, I have no idea what that is. What's that?
so, okay, well, that's where I'm going. I'm going to explain what a bail-in is.
Okay, sorry.
So in 2008, when the financial crash happened, they passed new, reform. So Dodd-Frank Act passed. Well,
Yes.
in Dodd-Frank, it now changed us as depositors of the bank as secured depositors to unsecured.
No.
So
Well, that sucks.
now, that's right. So now when you put your money in the bank, you basically don't own that money anymore. The bank does. You're just loaning it to them.
Whoa.
If they go into financial distress,
Yeah.
a bail-in means they have the right to confiscate your deposits
Yeah.
and use it. And
Wow.
in exchange, the law now says they only have to award you shares of the like company, like stock. So do
Wow.
you want stock in a worthless bank if they're in distress? Probably not. You want your money back.
It's not
And,
real. It's not real exciting. No.
and then people think about FDIC. It's a good thing I don't work in banking anymore, right? But in 2008, I was telling people FDIC was terrible
Yeah.
because back then I think the coverage was 100,000. It got increased to 250. With FDIC insurance, that fund is not fully funded. For
Yeah.
every dollar, for every $1,000 of FDIC, for every $1,000 are existing right in banks,
Yes.
there's pennies on $1 of 1,000 of how much is actually in FDIC coverage right now.
Gotcha. So but that's in the whole entire system. So you'd have to like just to push back on it. And I heard this the
Basically
other day.
two banks. There's
Okay.
enough
Oh,
money
there's
in
two.
FDIC to cover probably like two big banks, to not big like Wells or something, but like
Okay.
two notable banks to fail.
Okay. Yeah. So just for fairness to the discussions, I know what you're saying, and I also was like didn't like that at all. But in fairness to the discussion, like we have to have a major collapse. So let's just say one large bank took a hit. FDIC would come through potentially for a lot of those people. That was my take, but maybe that's not accurate.
That's how it's supposed to work. But if you go back to the savings and loan crisis of like the
Yeah.
80s, what happened? There was FDIC then, but what happened was the small banks that really need it
Sure.
didn't get it,
Oh.
and big banks bought up and gobbled up. So that's where I think we're going, almost like Fed Reserve 2.0. I think
Okay.
with CBDC rolling out, some small banks will get impacted. The FDIC won't come to rescue them. And, big banks will be told, or they just will go gobble up, and we'll be back to a very heavily weighted banking system of a few big banks on the system. So I personally, if I bank in a big bank, I only use a trust checking account because a trust account protects against bail-ins. Or I'm now banking at credit unions
Yeah.
if I can.
Well, amazing.
So,
All right, Nicole.
so
Well,
for investment fund people on the call, right? So it's a lot to digest, big stuff that's happening, but it's just worth thinking about how to protect investors' money. If you have
yeah.
millions of dollars,
Yes.
I would try to get a business trust checking account to protect that money.
Awesome. Well, that's a good place to conclude it, with a positive note and something that people can actually do. So you've talked about some just incredible, fascinating topics, like you said, that many are not thinking about or not aware of. But also, like you said, these things are actually, you could go look it up, you could read it. Like you said, there's proposals, there's countries buying into this central digital banking currency and all this stuff. So like this stuff's actually happening. So it's not just theoretical and just, some kooks, coming up with stuff. Like this stuff is actually going on, and this is the direction we're headed. So how do people get in contact with you, and what's the best place to find you? Social media, your own podcast, or what's the good spots?
Yeah, so I've not launched my podcast yet. I keep putting it off, but I am on LinkedIn. Probably that's a great place to find me, on LinkedIn.
Amazing. Yes.
Yeah, and then I do have a website called artemisadvisory.net, ARTEMIS advisory.net.
Yep. And
And
I'll put
so
that in
the
the
website,
notes.
okay, yeah, thank you. And yeah, I sort of do still private boutique consulting for big companies and government. but also I'm really passionate about helping kind of like entrepreneurs, small business owners be educated about all this stuff, to protect their business and their personal wealth. So I'm kind of like the full spectrum right now,
Oh,
but that's
amazing.
what the website covers. So
Sweet. Well, okay, everyone here at the Investing Stuff You Should Know podcast. This is what's been like an exciting ride, like a roller coaster of all the different things that Nicole shared and talked about. Nicole, will probably have to get you back on after, I don't know, 6 months, and we'll just like play this, well, not play it along, but watch how the game, we're kind of like the pawns being played here. We'll watch how the game goes and see who's kind of winning or up or down. So anyway, so thanks. I thank the audience for listening to another episode. Uh, Obviously, give us a like, give us a shout out, share the podcast with anyone that you know that wants to hear more of this kind of exciting and information, not just exciting, but like very relevant and valuable information. So, Nicole, thank you for being on.
yeah, thank you so much for having me. It was a pleasure.